But moving on, Bank of India recently reported their Q4 numbers. Interest income was flat. Net interest margins was up 3% sequentially. Meanwhile, the net profits nearly doubled on year-on-year basis. We have Rajneesh Karnatak, Managing Director of and CEO at Bank of India, joining in with us to discuss their numbers as well as talk to us about the outlook for the bank going forward as well. Thank you so much, sir, and good morning for joining in with us on the show. What I want to start by talking about is in terms of the profits of the company. This time we know in Q4, mainly, that was driven by recoveries. So I want to know in terms of what is the recovery pipeline looking like for FY26? What should we be expecting on that front?
Yeah, as regards our recovery is concerned, see, this year we have done a gross cash recovery of nearly 9,500 crores. This was against the backdrop of gross cash recoveries of around 7,800 crores in FY24. So very good recoveries we have done. In fact, we have been able to contain our fresh slippages also. So fresh slippages, if I tell, our slippage ratio has come down to 1.36% as against 1.53% as on FY24. So this year also, if I tell you our gross cash recovery internal management target, we have kept it around 11,000 crores on the cash recovery, which will help us overall improving our operating profit and net profit in FY26.
So 11,000 crores is what you are anticipating as recoveries in FY26. Mr. Karnatak, good morning. Thank you for joining in. But on the other side, sir, your yields, your NIMs are on a bit of a downtrend, and with the economy currently heading towards a lower interest rate scenario, what is the kind of margins that you are anticipating, A, for the first quarter and B, for the full year as well?
So our NIM is at 2.82% global NIM as on FY25, and it has come down by 15 basis point only on a YOY basis. Now, if you see our domestic NIM, it is at 3.10%, which is quite healthy. We have an international book of around 12%, because of which the overall global NIM was on a lower side, but domestic NIM is at healthy at 3.10%. With the kind of rate cut which has already happened, 25 basis point in February and another 25 basis which happened in the month of April by RBI on the repo side, there has been some pressure in margins. Without that, the transmission in deposit is yet to take place fully. The transmission would take another 6 to 7 months for the February and the April rate cut which is about to happen, which is there. So the NIMs will be under challenge in the first half of this current financial year, no doubt about that. But after it, it would stabilize and normalize.
Okay, so maybe first half, maybe we could expect some pressure on the NIMs, but later on, we are expecting that to stabilize going forward for the company. So, what about your CD ratio? Because that also has seen a slight bit of a dip in Q4 FY25. At what levels are you looking to maintain this? What should we be watching out for in terms of FY26?
So on the CD ratio, if you see, we have a very healthy CD ratio still of 40%. As you rightly said, it has come down from 43% to 40%. But nonetheless, we are one bank which has a CD ratio above 40%. Overall, if you see in the numbers, if I tell you the number on the CASA side, we have improved our CASA numbers from 2,69,000 crores to 2,80,000 crores. There is a YOY growth of 10,000 crore plus. As a strategy, we are very clear that on the domestic deposit side, we want to keep our bulk deposits within 14%. We are at somewhere around 13.8% only as on FY24, and majority of our domestic deposit will be either CASA deposit or retail term deposits, through which we will be able to contain our cost of deposits, which presently is also at a very healthy number of only 4.90%.
Mr. Karnatak, your credit costs have also gone up in the quarter gone by on a sequential basis. What are the credit cost trends looking like currently in this quarter, and what do you expect them to be for the full year as well?
So credit cost, if you see, in fact, it has come down from 0.78% in FY24 to 0.76% in FY25. On a YOY basis, it has come down by 2 basis points. So credit cost we will be able to contain in this financial year FY26, because we do not see much of fresh slippages happening. So slippages are also flat if you see FY24 and 25. That is why, in fact, the slippage ratio also has come down by nearly 20 basis points, and it has come down to 1.38% only in FY25. And this 7,500 crore of fresh slippage in FY26 is also contributed because of one large PSU account, which was nearly 1,000 crore. Had it not been there, our credit cost and our slippage ratio would have been far better. In spite of that, we have been able to bring down our gross NPA percentage to 3.27%, a reduction of nearly 171 basis point, and our net NNPA to 0.82%. And there also we had a good reduction of nearly 40 basis point. So this year our asset quality will be even better for FY26, both on gross NPA, net NPA, slippage ratio, and also the cost of credit.
Okay, better asset quality is what one could expect from the company in FY26. So, what about OPEX cost also? This time mainly sequentially, if I'm looking at it, mainly driven because of that staff expense, which has seen an increase. So, going forward, are we expecting any further more rise going forward here? And what is behind the sharp increase this time as well?
So, OPEX expenses overall, they are within control for us. And this staff expenses, which is a 12% YOY rise, is also because of the wage revision which happened and certain PLI performance links incentive that we have to give in this financial year, we have fully provided in FY25 itself. If you see our cost to income ratio, that has improved. So in fact, our cost to income ratio in FY25 has now come down to 50.84%. In fact, it has on a YOY basis come down by nearly 22 basis points. So we are very much in control of that, and we are trying to control our controllable expenses so that the overall operating profit, which has this time has improved by nearly 17%, and our net profit, which has improved by on a YOY basis 45%, shows the same kind of growth trajectory in the FY26.
Well, clubbing two questions into one, Mr. Karnatak, you mentioned that slippages you're not expecting too many slippages this year. But when it comes to recoveries, you mentioned that there is an 11,000 crore rupee target. Do you see that coming in from the agri and MSME sectors where there were slightly higher slippages in the fourth quarter? And what about your write-offs as well? Because your write-offs were slightly higher in the fourth quarter as well. So do you expect that number to trend down as well?
So we have done very good recovery in the return of accounts. So if you see our numbers from the non-interest income, the recovery has been much better. In fact, we have a OTS scheme for recovery in the return of accounts. There we have given targets to our field functionaries where we are doing very good recovery, and this recovery goes straight away into the PNL through the non-interest income. That is the first part. So other part being whether we'll be able to do better recovery overall. As I said that yes, around 11,000 crore of gross cost recovery we are targeting for ourselves, and this year we have done a recovery to fresh slippage of nearly 1.25%, which was only 1.10% in FY24. So in FY26 we are targeting this number to be even better than that, and overall what we feel is that our asset quality will be much better in FY26 at the backdrop of good recoveries, less of slippages, and overall the ratios of gross and net NPA would be better.
Okay, sir, thank you so much for joining in with us, giving us an insight and light into what we should be expecting from the company in FY26 in terms of better asset quality coming in for Bank of India as well. Thank you so much for joining in with us this morning. But on that note, we're going to slip into a very short break. When we return, we'll discuss market technicals with Apurva Sheth of Sampo Securities and also discuss the top trading bets.